Hi everyone. Hope you had a wonderful January. There's an old saying in the stock market that how January goes, so goes the year. And January's been kind of interesting. As we look at the numbers from the indexes, we'll see that the Dow Jones was actually down about 2%. The S&P 500 was down 1%, and the NASDAQ was actually up 2%. More interesting was the fact that the small cap stocks, the 2,000 smallest companies that are publicly traded in the United States, was actually up 5%. And what's interesting about that is typically in the start of an economic upswing, small companies and mid-sized companies do better. And so this could be a good indication that as we look into 2021 and into 2022, that we may see things continue in a more upward momentum. Something else that is very unique in January is the housing market. We've continued to see housing prices go up. The month-over-month rate was actually up 1.4% for homes. But more interesting than that was the fact that inventories have continued to drop. I heard a number that really shocked me, that across all of the United States, that there's barely over 1 million homes for sale. And actually, that's about 1.5 or a little bit more than that monthly inventory. That's tremendously low. Typically, a healthy market, they consider about 6 months worth of inventory. So if we're barely over 1.5, you can see that there's hardly any homes for sale, and definitely will be keeping prices higher for the next 2 or 3 quarters. Speaking of higher prices, we continue to see the stock market gain ground and go higher. Housing has continued to go higher. Oil prices now are kind of solidly over $50 a barrel. We're also seeing construction costs, steel, wood, things like that have continued to move higher. And there's a lot of talk in the financial world about, is inflation coming in later 2021 and 2022? It really is quite interesting. One of the other indicators that we're seeing is the yield curve or yield spread between the 2 and the 10-year Treasury. Right now, the yield spread between the 2 and the 10-year Treasury is actually greater than it has been since May of 2017. So what basically has happened is the 1 to 2 year range bonds have stayed relatively flat, but the 10, 20, and 30-year bonds have been moving higher and have made a really steep yield curve. That typically means that the economy will do better, so that's a good sign, but it definitely can also mean that the inflation is around the corner. And we're really watching this because we do think that there's a chance, with all the money that's been printed over the last year and seems like will continue to be printed over the next couple of quarters, that we could be facing some inflationary periods in probably mid to late 2022. But we're already starting to make some changes in our portfolios, both on the being protective on the more conservative side, and then how do we be more proactive on the growth side and take advantage of what we think will benefit from a little more inflation in the economy. We'll be continuing to watch to make sure that it's just more mild inflation and not something that gets out of control. The other thing that we want to watch is how quickly then the Fed is able to increase interest rates, because that's going to be the real key as to when the market starts to pull back. Usually by about the 5th interest rate increase, the market starts to roll over and we start to have a period of a down market. So we'll be watching that very closely over the next 12, 18, 24 months. I know we're doing all of our yearly reviews in January, February, and March. So if you have any questions before we get to you, please do not hesitate to call. And I look forward to speaking with everybody at the end of the month. Thank you.